Prices can vacillate a large amount in any one day. They can be up 10%, they can be down 10%. It doesn't mean the value has changed by that much. A market price is simply that. It is the market putting a price on the security. What comprises of the market? People. What are people? Emotional. What does emotional mean? They're likely irrational.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required. I am your guest host for today. Tim Bookmore will be unfortunately not joining us. So I'm Nathaniel Leach, and this is my business partner, Dan Weiss. Welcome to Critical Thinking Required. So today, just a reminder, as always, we're going to do that shameless plug as we always like to do. Please subscribe to our podcast. And with that, I'd like to pass the baton on to Dan.
Thanks, Nathaniel. So today, we're going to have kind of like a late show theme. And your guest is going to be, Nathaniel. So I guess it's the late show with Nathaniel Leacherman. I don't know.
That hurts. It's not cool.
So what we're going to talk about is we're going to spend a little time getting in the mind of a portfolio manager. That's why Nathaniel is a good fit for this. And we're going to talk about some do's and don'ts from a portfolio manager's viewpoint that maybe you don't necessarily see in common writings found through different publications. We're hoping not, at least. We're hoping to provide some more insight. So what we'll do, since he's the portfolio manager and I'm not, I'm going to bring up a few topics that Nathaniel and I commonly see, and he commonly stresses, highlights, complains on when it comes from a managerial standpoint from his job. We're going to talk them out a little bit. So here's going to be our top, whatever the heck it turns out to be, things that should be considered do's and don'ts of portfolio management. Correct. We're going to start with talking about time frame. And of course, everybody's like, oh yeah, of course, investments, time frame, and so on too. Easier said than done. And yes, this means that you need to give your investments time to play out. But we're going to talk a little bit specifically about a couple thoughts as it relates to time frame that maybe people don't necessarily appropriate correctly. So, Nathaniel, can you talk a bit about time frame as a do and a don't, long term and short term, the whole gamut?
Sure. So I'm going to try and pack this all in as best I can. So as Dan said, you want to give your investments time to run, but it really isn't as black and white as that. Because when you have a position that you know well, you've done your analysis on it, you're confident in the analysis of said position, and it has reached your predetermined price that you want to sell at. Let's say you bought it and then it's reaching that price. It doesn't necessarily mean that you have to sell. It's not black and white. It's not yes and no. That you have to allow for some gray. Because what may have happened is that perhaps the thesis has changed. Perhaps the thesis has changed for the positive. Perhaps the company has now increased your forecasted growth rate that you had originally posited and is now higher. So perhaps it would mean a higher price that you would be willing to sell at. Just because it's reached that predetermined price doesn't mean you have to go and sell it. The same thing is with the buy position. God, I can't tell you how many times over the years I've researched a company and the prices, it's like, it's just too much. It's too rich for my blood. But then looking back at it 5 years later, it was a compounder. It was a home run. It's very hard to let go of that bias. Because the downside is you could lose your client's money if you're overestimating a growth rate. So that's that it's a balance. You have to balance it out. You also have to balance out things like liquidity, in that if there have been situations with certain clients of ours that where some of them have been walked into buying illiquid assets, such as private REITs, for example. And what they sometimes don't realize is that these are not liquid. They are highly illiquid. There are things you have to worry about if you want to get out of them. You have to pay a redemption fee to get out. You have to, you will only get what is determined to be, quote, market rate, end quote. Who determines the market rate? The market. Well, I can tell you that these markets of these private illiquid REITs are very, very small. So the market that's dictating the price that you can sell out at, it isn't very wide. You're not going to have, it's not very liquid. So you may not be able to get the price that you want.
That's a great point, Nathaniel. So the private REITs we've seen a few times where it's sometimes taken years to get out of that because there's not enough people interested in buying. And if that does come up, what ends up happening is we've seen clientele having to take a 20, 30% or more cut off of that to be able to sell it. But it's not just even entities like that. There are publicly traded positions that we will come across where they just don't trade that frequently. And it's just not that large of a market for those entities. And people will buy those or not be able to buy those because of those situations, and have a hard time understanding what that actually looks like. So you have to always keep in mind that you are buying entity. You're buying a portion of an entity, a fraction of an entity. It's real like that. And that doesn't mean that you can actually trade it, at least not immediately. So that's a great point, Nathaniel. How about, Nathaniel, the short term? So these are things to consider, right, when you're looking to buy something and hold it for a period of time. We often get questions about timing as it relates to a short term, which I know sometimes gives you some heartache.
Yes. So short-term investments, by my definition, is anything less than 5 years. So if you are looking to pull your money out of anything within less than 5 years, you shouldn't be investing in publicly traded stocks. For example, you likely should not be investing in mutual funds, even if they are a bond mutual fund and bonds are supposedly meant for the short term. Well, that's not necessarily the case. Sometimes those bonds could be invested in long-term bonds. So you have to understand what you're invested in. Even if you're invested in short-term bonds, that doesn't mean that if you buy a bond today for $100 par value and you're earning a, I don't know, 3% interest rate, and then a year later you expect to pull out your principal, which was the $100 that you bought at par value, plus the 3%, there's no guarantee that you're going to get that out when you sell that bond. This is just if you're able to do it if you're buying a singular bond on your own, let alone a bond mutual fund, because that bond's price is going to be subject to the interest rates at the time that you try and sell it. So if the interest rates have gone up, the bond's price is going to go down. So you're not going to necessarily get what you put into it. So you have to understand what you're investing in. So we typically say that with anything less than 5 years, you stick it into cash or treasuries, which is essentially cash in my mind. Treasuries that are obviously less than 5 years in duration. And then there's also CDs potentially, depends on the term of the CD, et cetera.
And this subject came up recently. Nathaniel pointed out an article written a few weeks ago that was written in the Wall Street Journal that talked about the real estate market and where people were stocking their cash. And the article was doing fine until it got to a certain point. And that point was this point. And it, advising people as to where they should stick that cash for a purchase that might be 6 months down the road. That's just too short to do that for the reasons that Nathaniel just went over. There's always a level of risk, and people have a hard time understanding that risk because it's not tangible. But that's too short term to do anything with, but in our opinion, at least in today's market, be held in cash. Moving on to our next topic. Our next victim would be markets and market timing. Daniel, unleash.
Yeah, this is a big one. As Dan mentioned, there's two main parts here. So I'll first touch the markets. Constantly watching the markets and your market prices. There's pros and cons. The advantage to the advantage to having a market price that is able to move every second within the trading day can be extremely advantageous because that means that it's highly liquid, generally speaking. Depending on the float and outstanding shares and such. But that means that you can readily retrieve your money back once you invest in something. But this is counter to my point about you shouldn't be investing in publicly traded securities. I still stand by that. However, if push comes to shove, you know that you can pull out some of your money, worst case, to retrieve your investment in some form or another. The downside, though, which is what I really harp on, is the problem that you're looking at your prices all day. Prices can vacillate a large amount in any one day. They can be up 10%, they can be down 10%. It doesn't mean the value has changed by that much. A market price is simply that. It is the market putting a price on the security. What comprises of the market? People. What are people? Emotional. What does emotional mean? They're likely irrational. So that's kind of how I would play the markets in general, in that it can lead to poor emotional decisions if you see that price gyrate too much.
And this may sound crazy, but don't look constantly at what your investments are doing. It doesn't matter. We often get in that conversation where someone will be, oh, well, it was down the last month or whatever. And that money is assets they can't even touch without penalty and taxation for 30 years. It doesn't matter. It's not indicative, like Nathaniel's saying, of the value, those price movements. So statistically speaking, we've seen research showing that constantly looking at your portfolio, it makes sense, will cause you actually to do worse because you'll become emotional and make movements when you just shouldn't. So it is healthy not to let it suck you in all the time. And that gives it, back to the first point, time for that investment to actually have time to build up. Nathaniel, can you put some numbers to some of the issues we've seen when it comes to market timing?
Indeed, I can. So using the 20-year period from January 3rd of 2000 to December 31st of 2019, and if you had invested in the S&P 500 $10,000 on January 3rd, 2000, by the end of that period, you would have $32,421 for a return of 6.06% annualized. Now, if you had been out of the S&P 500 for the 10 best trading days, you would instead have $16,180, which is a $16,241 difference, so over half, and a 2.44% annualized return. That's the 10 best trading days. 10 best trading days out of, God, I think there's 260 trading days in a year, give or take. So if you had been out of the trading for 0.2% of all trading days, you would have less than half of $32,000 left.
Less than half. Okay, hopefully we'll just give that a second to burn into your head for a minute. We've so far covered probably two things that people expect, right? Time horizon and market timing. So this third one is maybe something that you don't necessarily think about, but extremely important. And that is setting parameters for your mindset, right? As to how you go forward with your investments. This is a big deal. I don't know that it comes across most people's minds because they don't know to do this, but it's absolutely essential for any portfolio manager to have what parameters they're going to build out. Nathaniel, could you speak about this?
Sure. So when it comes to a parameter mindset, what we're speaking to is that you want to set the parameters before you invest. So alluding to what I mentioned about picking a buy price or a sell price. It's really a buy range, sell range. You want to choose those before you make the investment. But that doesn't necessarily mean that you leave them alone and just forget about them. You update them as your thesis changes. It's like I love to say, I'm parodying off of what Dan has said in the past, is that when it comes to, if you start a business and you have partners, right, you do an operating agreement. This is an agreement, a document that forces the partners to act in a certain way when certain things occur. You do this operating agreement when things are good. You don't do it when the shit has hit the fan. It's the same thing when it comes to investing. You want to make sure you understand how well you understand this investment, that you have a buy range and sell range in place. And then when you come up to that sell range at some point in the future, you reevaluate where the company is, as if something fundamentally has changed, positive or negative. You either sell or you hold on. Maybe you pare back. There's a range of different possibilities available to you. But the important piece is that you think about these things in advance when the emotions are not running hot.
Very well said. Not just because I often say that to people, but very well said. I mean, another example would be like a prenup, right? There's a reason why it's a prenup. You do it before, because if you do it after, it's because something has already gone awry from what you expect, and now it's a lot harder to clean up. Same thing. If you have this stuff in play, then you're ready for it when it comes. And this includes like building out, which Nathaniel, I'm going to maybe ask if you can give some examples of this, but when you're building out these parameters, it's also about deciding what kind of entities make sense for you. It's circle of competence conversation we've had many times over. What kind of entities make sense for you? What pulls your attention? What are you good at? You know, and it's helping also figuring out how you're going to evaluate those entities, which we inside the firm refer to as filters. So Nathaniel has built filters, as every portfolio manager has. They look very different between manager to manager, but these are guidelines that he has built in to basically keep him honest as to what he's looking at.
So what Dan is really referencing is how you, as a part of the parameters, you have to, then what falls into that is the weighting of positions. How much do you weight a position at? So I'll admit, when I was young and dumb back in the day, I would kind of suffer a little bit from FOMO, in the sense that when I saw what I thought was a good idea, I would load up on that sucker. But as time has gone on, I've come to realize that if I am in the market for quality compounders, that is, companies that are growing at high returns on invested capital, which then means higher growth of future free cash flow in the future, then you don't need to have a very high weighted position to that. Instead, you can start small, you can build into it. And then even if you miss out, even if the price rises above what you deem to be a good buy-in range, that's okay, because it's consistently compounding with time. So the weighting that you may have originally started at, it's going to be much higher in the future. So you don't need to go heavily weighted right at the beginning. Let yourself grow in, let the position grow into itself. You want to allow for a margin of safety in your analysis, because you might be wrong. So there is no harm in starting small and then just letting that sucker grow.
This is our fourth topic, weighting. Also, not often talked about, right? And I think we could probably, this has been a learning lesson I know Nathaniel has shared with us over the years too, is his growth in understanding what weighting means. And what weighting is it's figuring out how much one particular fund, one particular position should equal within the overall arching other positions surrounding it, right? Is that weighting, meaning is that position going to make up 2, 4, 10% of a concentration in the portfolio? This is one of the most difficult things for a portfolio manager to do, Because again, if you overweight something and it's significantly you better feel really good about it. Because if it goes south, it's going to really hurt. If it doesn't go south and it has a great return, you're going to look like a hero. So it all depends on a number of factors, starting with comfortability in that position. So weighting is really important to understand. It's very difficult to do. I know, and if I misspeak, correct me, please, Nathaniel. I don't even have to ask that. I know you will. Earlier on, years ago, Nathaniel would build out a position entirely from a weighting standpoint. But like he's saying, and not all the time, but this happened a couple times, it didn't leave room to grow. So this kind of goes back to that point number one, the time horizon that we just spoke about. What ends up happening is hopefully these positions grow. As they grow, they're going to, if they grow quicker than other positions, that weighting, that concentration is going to get larger and larger. This can create some uncomfortable components for people that are not comfortable with higher concentrations, which, by the way, is just about everybody. Okay. Maybe you're like, I'm fine with it. A lot of people say that too, and maybe you are, but a lot of times it's not the case, right? So you're fine with it until it has a rough day. So that's usually what we see. So understanding that was an issue because we didn't allow for some entities at times to grow because it had to be balanced with what weighting it took now in the portfolio and where people were comfortable with that, right? So you have to consider that. So it might be all right to step into it. I think that's a phrase Nathaniel used a second ago, to buy in, test the waters on something, and then buy in again, especially in an environment, we're going to come back to this as a point, especially an environment where you depending on what you buy, there may not be any trading costs. So before, a couple of years ago now, this was definitely a concern in building out portfolios, as you had to bring in, there's a transaction cost, a commission that could be applied when you're building out a position, which then would counter with a portfolio manager's comfortability in adding increased fees to be able to do that. But a lot of that has disappeared with the reduction of commissions, trading costs, or elimination, which we're going to come back to. Number 5, fad chasing. We've seen a lot of it. That isn't new. I should back that up a bit. We always see a lot of fad chasing, right? It was a couple years ago when there was a lot of push on crypto, really Bitcoin, right? And now we see another push the last year and a half, but not just about Bitcoin, right? A lot of others that weren't players 4 years ago, 5 years ago, when we saw this occur and had a bubble then, right? There has been fads in cannabis that we have seen over and over again. There have been fads in particular sectors, right? Like pharmaceuticals, real estate, obviously. This is nothing new, but we see a lot of different fads really since the recession in March of 2020. And so let's talk a little bit about that. It's really turned upside down, I think, the marketplace as it stands today. And it's probably not going away. It can be a very dangerous environment.
Yes, fads have and will always be a part of life. There's always a fad. I remember the days when Beanie Babies were a thing. They're not a thing anymore. There will always be fads in life. That's how I would say that. So speaking to some of those fads, there's Bitcoin slash cryptocurrency. We've also had numerous discussions with our clients about real estate as an investment. More recently, specifically, there was the meme stock fad, GameStop, AMC Entertainment. Most of these moves have no bearing on reality. I should say moves by the price moves increases. Most of these have no base of reality. SPACs, we have recently seen the SPAC bubble come out. And SPACs aren't new, folks. SPACs have been around for decades, I believe. So it's funny to see these things pass by because if you look at history, most fads have gone away. When I I clarify by most because one could have categorized mutual funds or ETFs, index ETFs as fads, but they're still around. But I would argue that those have validity in any investor's portfolio if you know what you're investing in.
The next one, I really asked Nathaniel if we could talk about this one. He sees it all the time too, but I'm getting a lot of questions as it relates to taxation. And here's where I'm seeing some of these questions come up to play. There's a lack of understanding or consideration that we often find on how taxation impacts a portfolio. Where I'm seeing a lot of it from a question standpoint, and then I'm going to yield to Nathaniel to talk about this a bit too, is, for example, we have seen people invest money in providers like Robinhood, where Robinhood does not offer a qualified investment platform. They offer a non-qualified investment platform. That means that it's missing out on some tax benefits that, say, your IRA, Roth IRA, 403b, 401k, et cetera, offer. So a qualified account would be an account that has additional tax benefits, such as a Roth IRA, where you pay taxes up front, and then the idea is you don't pay taxes again. Or a pre-tax traditional 401k or IRA, where you're getting possibly a deduction up front and tax deferred growth. And then you're taxed in the back end. But the idea on both of those situations is that you're taxed once. Whereas a non-qualified account, typically this would be anything that doesn't have that qualified umbrella over it. But this is a brokerage account is typically where we see this, where you're taxed multiple times. Because you're taxed because you received the money from your employer, so you got taxed there. You've then invested that money, and then you're taxed on all of the gains, which means that you had an investment and you sold it, taking an unrealized gain to a realized gain, and then creating a taxable environment, right? You're taxed, and I don't want to get too deep into here. The taxes can be different. It depends if it's a long-term capital gain or a short-term capital gain. But these are things you have to understand because that can save you a lot of money. So dialing it back, what we've seen a lot in the last year and a half is someone saying, oh, I purchased this in Robinhood. There's no purpose behind it, which is something that we, needs to be considered too, which we don't have on our list today, but putting purpose to your investments is really should be a do and don't as well too. But the problem with that is if that individual doesn't plan to use those funds, they may have been better suited putting that inside of their Roth IRA or their 401k because they would have saved on the taxation. I don't know how many times we had people that had bought something in a non-qualified account through Robinhood or another platform, sold it, and they were very, very happy about their gain. But they sold it in 2 or 3 months, which means that it was short-term capital gains, and they paid ordinary income tax on that investment. So if you're in the state of California, you could be losing over 40% between federal and state taxes on that investment. That's a problem because what we were seeing was then people would take that gross proceed, invest into something else, lose that money, and then next year they get a tax bill that they don't have the money for. They weren't expecting. So that's my pain point among our list. Nathaniel, anything else you want to add to understanding taxation as it relates to a portfolio manager's viewpoint?
So from the portfolio manager's viewpoint, short-term and long-term capital gains has and always will be a consideration. I don't put as much emphasis on that as some, if I would argue most investment managers do, because I care more about the long term, which means that I'm likely not selling in the short term. There have been very rare occasions where I do sell in the short term by choice due to some catalyst event. For example, we held a position in a company years ago, and for some clients, I bought it today. And then a week later, we got notice that it was being bought by another company. There was a known closing date range, but I felt like it was in the client's best interest to lock in that price at a much higher price than what I bought in at a week prior and capture that gain and then be able to reinvest those proceeds elsewhere. So that's in very rare cases does that occur. So speaking to tax loss and wash sales, so tax loss harvesting, again, a number of investment managers make this a big point. I think it's a crock of shit, honestly. I think that in very few occasions should it be applied, because so here's how tax loss harvesting works. At the end of the year, let's say you have a position which you've lost a great deal of money on. So you have a large unrealized tax loss. Let's say 12/31, you decide to execute on that and make it a realized tax loss. The wash sale rules dictate that you cannot buy that same security or a security that is similar to it for another 31 days. Because if you do, then it will be considered a wash sale, which means that that tax loss that you would have realized for that year would no longer be applied, because you had bought the same security or a security similar to it within that 31-day period. That would negate that tax loss that you would have secured beforehand. The problem I have with that is that a security's price can be extremely volatile within a 30-day period. The statistics for over a year period, the average stock price vacillates by 50%. So you could potentially lose out on a security that may have not only bounced back to your cost basis, but may have bounced back to the point where you're achieving an excellent return on that investment. That's market timing in my mind. It makes no sense. There are very few occasions, as it is with short-term and long-term capital gains, where tax loss harvesting makes sense. In most, it does not. And that is my opinion.
Let's do one more. And we referred to this one earlier. Nathaniel, if you could talk about basically classes and commission fees.
Sure. So for classes, what we're typically referencing there is mutual fund classes. So mutual funds over the decades, have created a number of classes of their mutual funds in order to cater to different customers. So the mutual funds are typically distributed through many platforms, some of which include like a custodian like Charles Schwab. Or in some cases, they're distributed through wholesalers that go towards advisors like us, and the wholesalers get paid somehow, and then we put our clients in a certain class of the mutual fund. In some cases, there's situations like I would say that Edward, as an example, they are typically pitched to distribute certain mutual fund classes, and then they are typically then receiving something in the back end. To make it clear, we receive nothing in the back end, folks. We are fiduciaries. We're not going to do that to you. Some advisors are not fiduciaries. They will receive something on the back end for putting you in a specific type of class of mutual fund. You tend to see higher fees in those kinds of classes. You see loads, that is front end loads, back end loads. Some horrendous ones we've seen is that you have to pay a 5.75% commission rate, essentially, which is a type of front end load within a particular class of mutual fund. That's 5.75% right off the top of your contribution. And then on an ongoing basis, it's then subject to an expense ratio or fee within the mutual fund on an ongoing annualized basis. Actually, it's typically drawn on a monthly basis. So we don't like those kinds of classes of mutual funds, and we do not stick our clients in those kinds of classes of mutual funds. For commissions, the big thing is Dan alluded to was that a few years ago, we saw a number of platforms offer the purchase of and sale of equities at $0 trading commissions, which is fantastic for the consumer. But there's always a but. But the problem is that some of these platforms that brought their trading costs down to zero, one that an infamous one is Robinhood. They brought their commissions down to zero in return for something called order flow. So with Robinhood's brokers, they came up with a deal whereby Robinhood would drop their commissions to zero, but in return, they would basically pass on that cost to the consumer by their brokers doing something called order flow, which means that Citadel is basically running a spread game on any orders that pass through Robinhood from the consumer through Robinhood to Citadel, which is one of the brokers. And Citadel then makes a spread off of that trade. So you are in fact paying something for that trade, which likely means that if you put in a market trade and something is trading at $10 a share today, Citadel is probably tacking on a few cents per share to that order. Few cents, 10 cents. It could be any number of it's unknown, but they're tacking on a small spread. And then you can imagine as the flow of orders come in, this can become quite a good business for the broker. That's how Robinhood is able to onboard a whole bunch of people, in addition to many other factors that we're not going to get into here.
And another confusing point too is that when those exchanges brought those fees down to zero, it's not for every security. So some places like an OTC, right, over the counter transaction, there can and likely happen to be still a trading cost. We see it if we're buying a foreign entity. Often there's a trading cost still come into play. So just keep that in mind, because we've definitely also seen a scenario where someone's like, oh, there's no more trading costs, but then they end up buying one of these entities that does have it, and they rack up a lot of money in trading costs. Well, that is why. Okay, we could do this forever, but we're not going to do that for you. So, or to you, I should say. Hopefully that was insightful. Nathaniel, as we wish everybody a good afternoon, any parting thoughts, or do you feel you've said your piece?
I don't have anything to add. No.
I thought he might say that. I have just, I got two quick thoughts actually. Thought number one, if you can't stand the heat in the kitchen, get out of the kitchen. And what I mean by that is, if you don't understand, if you're managing assets and you feel really comfortable about understanding these kind of things and more, great. If you find that this gave you a headache, if you don't understand some of these things, then don't put yourself through it, right? We always say don't do things, whether it's investing or not, that you don't understand until you do understand it, right? So keep that in mind. And that goes for any kind of investing. There's other things underneath the hood that you might try to at least become educated on it. But the other component I really wanted to add in, which I think hits a lot of these pieces. And again, this is something that we see a lot of the last couple years. Traders are not investors. Trading is not investing. Trading is you exchanging one thing for another. Investing is you're buying an entity because you believe that entity is going to produce a greater return, and you have a thesis behind it to lead you to that thought process. Those are very, very different things. I would beg to say that we see a lot more trading today than we do investing, and just understand the difference between the two. We're not talking about 1995 and selling Beanie Babies here. There are more things that go into it because you are investing in something for the future. With that being said, the two of us wish you a very good afternoon. Thank you for joining us on the podcast as always. We appreciate your attention, and until next time, take care of yourself. Thank you.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.